Good afternoon, everyone. We're back for episode 3 of our Basics of Borrowing. We just went live, so we're going to wait a couple minutes and make sure anyone else that wants to join us gets on. All right, we'll go ahead and get started here. So my name is Willie Wilson. I'm a loan officer here in Lexington with AgCredit. I've been with AgCredit for going on 9 years now.
And I'm Joe Goggin, also a loan officer here in Lexington. Been with Central Kentucky AgCredit for over 25 years now.
So last week we were here and we talked about capacity, which is repayment capacity. I'll just do a real brief recap. We talked about what capacity is and how it means it's your ability to repay your obligations, your debt service with the profit that your farming operation, your off-farm income contributes. And then this week we're going to talk about capital. Before we get to capital though, we'll say why we're here. We know a lot of people are home right now for everything to do with COVID-19, so we're providing an educational opportunity for people that may be interested in what credit is and how we do what we do. Joe and I are standing 6 feet apart, so we're social distancing. We've got that locked down. So we'll go ahead and get started with capital.
Yeah. So when we talk about capital, what we're really talking about is your financial position, financial statement. And we put up an example of a financial statement up here. And basically when we talk about a financial statement, you may also hear the term balance sheet, and they're synonymous. Some people will say balance sheet, some people will say financial statement. The reason for the term balance sheet, it goes back to an old accounting term because you have assets and you have liabilities and you end up balancing that at the bottom. So what we'll talk about today is the financial statement, and then towards the end we'll also correlate that back to last week and how it connects to capacity that Willie was talking about. So I'm going to begin, when you have a balance sheet, if you'll look at it as two sides. On the left side are assets. Now, assets are things that you own. It could be a vehicle or it could be cattle. Anything that you own that has value are assets. And there's two types of assets we'll get into. And then on the right side are liabilities, and that's what you owe. I'm going to start out by talking about current assets, which is in the top left quadrant. If you think of a balance sheet, basically as in 4 quadrants here. On the left side are assets, the right side liabilities. The top half are current assets and liabilities, and the bottom half are non-current. And we look at the current for a couple of key ratios, but we'll start on the asset side. Current assets we typically think of are things that you own that you can convert to cash or that will be converted to cash or near cash within a 12-month period. And obviously that can be items such as cash, checking and savings accounts, if you have an account receivable. And the key thing with accounts receivable would be if it's collectible. Now you can say somebody owes you $10,000 for something that you sold last year, but if you think that's likely not to be collectible, then we probably would not put it on here. Ag inventories. That gets into, on the current asset section, like how many rolls of hay do you have, or how many bushels of corn do you have in the bin. It's ag inventories that you have on hand.
Medicine supplies.
Medicine supplies for cattle operation. You can also have investments in growing crops. This time of year, here it's April, we've got a lot of people that have already bought corn seeds, soybean, their seeds, their fertilizer, spray materials. Those are actually assets that you've purchased, even though you're in the process of getting ready to plant corn or beans. we can count that as an investment in growing crops. If you bought those in December and we were updating this financial statement, say in January 1, we would show it as a prepaid expense. You paid for it in December, you're going to use it here this spring. Feeder cattle is another current asset. Obviously, if you buy feeders, especially this time of year, you're going to background those feeder cattle and they'll be resold here in a few months. As I said, hay or other feed inventories, any grain inventories, tobacco. This is one that used to be a lot bigger than it is now, but we'd have people that had tobacco in the barn or stripping and that hadn't been sold. Any other current assets then you can list. And basically we add the total of the current assets, and then we'll come up with a subtotal here, and then we move down into non-current assets. And that can include machinery and equipment, vehicles, breeding livestock. While the feeder calves or the calves after you wean them are included in current assets, the cows are included in non-current because you're not likely to sell those within 12 months. Retirement accounts or 401ks, you'll see on here, you'll see on a lot of financial statement, cash value of life insurance. Now, that's something that you need to be careful when you put down. A lot of people have term insurance, maybe through work, but it does not accumulate a cash value. What we're talking about here is actually if you cash that life insurance policy in, what's the cash value? Does it accumulate one? Real estate is also, that's a main one on the non-current assets. So then we come up with a subtotal for non-current, and we add our current assets and our non-current, and we come up with the total assets. One key thing to think about when you're putting down assets on your financial statement is using a realistic number, especially if let's use a vehicle for example. If you purchased a truck 2 years ago and you paid $30,000 for it, if you come in here and put $30,000 as the value of that vehicle today, it's probably not realistic. So what you need to do, whether it's equipment, vehicles, livestock, put the true value. If you had to sell that asset today, what's it worth? That's really what we're looking for on that. I think Willie's going to talk about liabilities.
Yeah, so as Joe mentioned, the right side of the balance sheet covers all of our liabilities. So these are loans or any money that you owe to anybody, maybe not even in a loan. And then we've got the same thing going on this side. We've got the current liabilities in the top and the non-current liabilities in the bottom. So up here, we're going to list out any unsecured lines of credit. So this would include, say if you've got money borrowed out of Southern States or go to your feed store and you owe them $1,000, $2,000, you'd put Southern States, $1,000, and then what the payment on that is. Down below here, you'll have a secured line of credit, which would be if you had, say, a line of credit with your lender to cover all of your operating costs or to buy feeder calves or whatever you may have. That's where you're going to report those there. Credit card balances are up here, unsecured line of credit as well. So you want to report that as whatever the balance is the date of your balance sheet here. We're going to do the same thing on this side. We're going to total up all of our balances on our secured and unsecured lines of credit. So these are all balances due in the next 12 months. Then moving on down to the bottom, we've got installments. So that's what we would call like a term debt. So if you've got an auto loan on your truck, you can put who your lender is, the balance as of the day of the balance sheet, what your payment is, and how frequently you pay. Other loans down here would be farm real estate loans, home loans, student loans, leases, things like that. So anything that you make a regular installment payment on is going to be down here. So it's something that's been termed out. We're going to do the same thing here. We're going to total up all of our current liabilities. We're going to total up all of our non-current liabilities and add them together for a total liability. Before we move on, I want to say that this balance sheet is available. It's a link below our video here. It's also been posted onto our website. We've got this balance sheet, which is a pretty basic balance sheet that's really helpful for a lot of people. We also have another balance sheet that's a little more advanced for maybe a full-time farming operation. If you've got any questions about that, you can reach out to us and we can help you work through those.
You want to talk about current assets versus liabilities?
Sure. Yeah.
Remember that working capital?
So one of the things we look at when we do these balance sheets is we look for something that's called working capital. So working capital is money or near money that can be used to cover any sort of immediate debt service you have. So we always say that working capital is your first line of defense when you don't have profit coming off your operation that can cover your obligations. Working capital is what backs up everything for you. And again, liquidity is how much cash do we have over here that more than covers these balances over here. So we want to look at a ratio that's at least 1-to-1 typically. So if we've got $50,000 of current liabilities over here, we want to see at least $50,000 of current assets over here.
Right, and that's where, let's, for example, say somebody has $10,000 worth of current assets, and then they fill out their, they have a line of credit, maybe they have a credit card balance and some payments due in the next 12 months, and so their total current liabilities is $7,000. So the $10,000 minus the $7,000 in debts, they would have a working capital margin of $3,000, and that's why we look at this area on the top part of the balance sheet as important. That's their liquidity on their working capital margin up here. Now, if we filled out a balance sheet on somebody and they had, let's say, $50,000 worth of feeder cattle here, and they had a line of credit for those feeder calves, and it had a $75,000 balance, then we would start digging in a little deeper as why do you owe $25,000 more for these feeder cattle than actually what they're worth over here. And there's some reasons for that. Maybe it's some losses from the previous year, or it could be that the market, like right now, has taken a downturn. And now we update this balance sheet and we find these cattle not worth as much. So it's important that we look at this working capital margin. We'll go into a couple of other key ratios on this. As you look at the balance sheet, like I said before, we come down to, we add our current assets and our non-current assets, and we get to a total asset line. And we do the same on the liabilities. And so basically one key bit of information we look for is total assets minus total liabilities is our owner's equity. And that basically demonstrates how the dollar value of assets that you have that are debt-free. And we also look at that as a percentage. We'll take that owner's equity dollar amount and divide it by our total assets. And you may hear the term sometimes, what's your owner's equity percentage? That's what we're looking at there. So we want that to be typically 40% or better.
And something important to note too is when you report an asset, it's anything that you own, even if you've got a loan out on it. Say you've got a truck that's worth $40,000, but you still owe $10,000 on
True.
it. We want to show the $40,000 value over here and the $10,000 loan. Just because there's a loan on it doesn't mean you can't report it as an asset. You still own that asset.
That's a good point. And sometimes people forget about that. And when you're filling out a financial statement with your lender, sometimes they'll leave some assets off and they'll say, well, I owe on that. Well, that's okay. We still want to show the asset at its value that day and offset it with the debt, because then the difference in that is the equity that you actually have.
And on that note, so sometimes, especially with young first-time farmers, people are just getting started out, we'll see some things on the balance sheet that can hurt you. So we mentioned the truck. We've got the truck over here and the truck loan. When you have a student loan over here, there typically is not a corresponding asset that can be reported on your balance sheet. So that hurts your equity ratio. That hurts your net worth because you've got a loan, say for $25,000, but there's not a corresponding asset that helps offset that balance.
Right.
And that can be a difficult thing for a first-time farmer to overcome. But we have tools and programs in place that we can utilize that help those first-time farmers. We work heavily with the Farm Service Agency. We're a preferred lender with them, and they've got programs that we can utilize to help offset that underwriting ratio that we need to see for the equity.
One thing to remember too is, and a lot of times I know it's kind of hard to remember sometimes everything that you want to that you need to put on a balance sheet, but especially when you get into the liability side, is your lender's probably going to pull a credit bureau. Mm-hmm. And so they're going to be verifying some of these debts through different methods, and one of them is by pulling your credit bureau. I think we discussed that in the first week of these sessions. And so you want to be sure, you don't want your lender to pull a credit bureau and then find a couple of loans on there, or maybe credit card debt with 3 different credit cards that you didn't report on your balance sheet. Mm-hmm. If it's a loan or a debt that you have, be sure to report it, because they're going to try to verify this balance sheet.
Mm-hmm. And we do the same thing for assets as well. When we've got a group of cattle and
Right.
you've got cow-calf pairs valued at $2,500 right now, we're gonna pull a market report and say, well, maybe they're only worth
Right.
$1,200, $1,500, and we'll have to make those adjustments after the fact.
Right.
So it's a lot easier and better for everybody to do that up front.
And that's a good way if you're not sure what maybe cattle are worth. Get on the internet, pull up a market report for a livestock market near you, and that's just a good guide to use for coming up with the values of your livestock.
There's other websites, Kelly Blue Book, that you can use to value vehicles and machinery, Peak Machinery Trader for farm equipment.
Right.
It's also important to be consistent with your values. When you update your balance sheet annually, which is what you should be doing every year, you don't want to have wild fluctuations in your values because that can lead to false trends. So if you've got real estate valued at $100,000, well, if you haven't actually had your appraisal updated, you probably just need to leave that where it is.
Right.
Yeah.
Right. And that's also, items such as cows, breeding livestock. As we see changes in the cattle market, you don't want to come in every year and fluctuate the value of those cows. I mean, it's just for comparison purposes, for year over year, it's just better to leave them at a base, standard price on that instead of showing these $300 and $400 value changes per year on those.
And on that same thought, you want to try to update your balance sheet at the same time every year.
Absolutely.
If you've got a balance sheet from January 1 and you update it again in the fall when you've got 10,000 bushels of corn in the bin, it can skew your comparisons. So you want to be on the same frequency as you update your balance sheet for comparison purposes.
Right.
And you can update them whenever you want to, but you don't want to compare a January 1 balance sheet with an October balance sheet.
I like to tell people it's really good to update your financial statement every year at year end. And there's a couple of reasons for that. One, for consistency purposes. But then two, and even if you're not planning to borrow money that year, I would still go ahead and update. You can do this at home. It doesn't take hardly any time. You save last year's in an Excel file or whatever form you have it in. You pull it up, make the changes, and probably in 15 minutes at home you can have your financial statement updated year in. But then if at any time during that year you need to borrow money, you can take that year-end financial statement to your lender and you're good to go. And also, it will help when it comes tax time, because if you have inventories of feeder cattle or grains on hand or anything like that, then you've helped your CPA complete your taxes because you have a year-end balance of your inventories right there.
And I would also say be as detailed as you have time to be. Don't put just down $100,000 of farm equipment. You can have a list off to the side that is a supporting
Correct.
document to your balance sheet that says how many tractors you have, the year, the make, the model, and what the value for that specific piece of equipment is. Or if you have cattle on different farms, it's good for your own record keeping to say, well, I've got 15 cows on the Wilson farm or wherever, and that helps your lender verify those values as well. And you can, maybe you've got some cows that are worth more than the others, you can have different values on different groups of cows.
Right. And that list of equipment, again, that helps your CPA complete that depreciation schedule every year. You'll find out you're writing your CPA a little smaller check to complete your taxes by spending 15 minutes and updating this
Also
every
good
year.
for insurance purposes to have a
Absolutely.
detailed list of the
Absolutely.
inventories.
One thing we haven't covered, and we said at the beginning we were going to, so you've got your total assets and you've got your total liabilities. You subtract your liabilities from your assets and you get your net worth. Now, if you do this every year, December 31, January 1, and you complete this, and let's say your net worth here is $173,000 this year. Well, last year it was $123,000. So you've had an increase of $50,000 in the last year. Last week, Willie and Dan went over capacity, and they talked about tax returns and the earnings statement. While tax returns are kind of how we gauge your income and your capacity, this change in net worth year over year is also a good indication, and there's a correlation between your earnings and that change in net worth.
Right.
If your bottom line of your earnings last year on your taxes said a margin of $45,000, and we're coming in and seeing a change in net worth of $50,000, that's a very close correlation.
Mm-hmm.
And so you can use that to gauge where you are every year.
And you can also monitor, do you see values moving from the top of your balance sheet to the bottom or vice versa?
Right.
Are you liquidating assets to make yourself more top heavy, to give you more liquidity? Are you going vice versa? You can kind of monitor all four corners from year over year and see the trends in your own, your home and your farming operation.
Exactly.
So we'll open up to questions unless you've got anything else to say.
Okay, we have a few questions. The first is, how do I come up with the values?
Well, that's one thing I think we touched on briefly, but depending on the asset, if you're looking for values of equipment, you may go out, there's all kinds of sites like tractorhouse.com, Machine Repeat. Occasionally you'll see auctions in your area that you may find similar types, pieces of equipment that have sold. If it's cattle, there are websites you can go to. If you're here in Kentucky, especially central Kentucky, you can pull up some of the stockyards, livestock market, marketing reports for any livestock market in the country, and come up with, especially feeder calf values. Vehicles, obviously, you can go out on Auto Trader or any type of a Kelley Blue Book, type value on those.
Okay. How often do you take a balance sheet?
We want to say generally you should update your balance sheet every year. Again, around the same time of year, whether it's in December 31st, January 15th, somewhere, as long as you do it at the same time each year. With that said, when you come into your lender and ask for a loan, you're going to want to have a balance sheet that's generally probably no older than 90 days.
Right.
So you can bring in your year-end balance sheet, but you're going to want to have updated it to closer time of your loan application.
And what you'll find is, even if you do it at year end, there's probably not going to be a tremendous amount of change from then that you have to update, say, until this time of year.
I got a question. Do you include any personal property like antiques or gun collections or anything on?
Generally not. I mean, we'll have people put down, gun collections or coin collections classic cars, and those things, those types of assets are so difficult to value that as a lender we'll discount that heavily. Those are so dependent upon how you can market them. And you got to keep in mind the values of our assets is really determined on what is that value if you had to sell it that day. What's its market value that day. And when you get into coin collections, knife collections, that type, that can be all over the board.
And something that we forgot to hit on is your balance sheet before you borrow money to buy a farm versus your balance sheet after the fact, or a tractor, whatever it is. So we look at it both ways. We look at the balance sheet today and we say, okay, tomorrow after we close the loan, that's where we want to see an equity ratio of 40% or greater. So if you come and you borrow $250,000 and you put 10% down, it's going to have a pretty large impact on your net worth and your equity ratio. And that's what we want to see is what's the equity ratio after the fact. So that's an important thing to consider. If you're today sitting at an equity ratio of 40%, without utilizing programs through the FSA or Kentucky Ag Finance, something along those lines, it can be difficult to obtain a long-term loan.
What if I have a low net worth and want to borrow money?
You want to do it? You mean?
Oh, go ahead.
Well, and I was getting ready to mention that. We talked about getting in our kind of our benchmark on the net worth or owner's equity percentage being 40%. Especially if you're a younger borrower, we have tools available to us. Willie just hit on one is we can do guaranteed loans through the Farm Service Agency. There are also loans that we can do through Kentucky Ag Finance Corporation in Frankfort that allow us to participate loans through them. And so we have some programs available if somebody has a lower owner's equity and you're looking at making a purchase and need to borrow money.
We can also consider offsetting strengths. If there's other factors in the credit package that would maybe offset a low or non-existent net worth.
Strong earnings, strong collateral.
Yeah. If you've got other sections in the C's that we've talked about that are above average that can maybe offset some of that, that's certainly a consideration.
Right.
Okay, I guess that's all we've got today. We'll be back next week, same time, same place.
Yeah. Next week we'll talk about collateral and conditions.
Yeah. Thanks for watching.
Thank you all.
Have a good day.